Good afternoon, everyone. Thank you for making the time to come here today. My name's Crispin Lilly, so I'm CEO of Everyman. A very, very quick flashback on how I got to be here. Coming up on my 5th anniversary at Everyman. Spent coming up also on the end of my 3rd decade in cinema. Spent 22 years previously at Cineworld and the various companies before it that evolved into that. So I'm the old hat in terms of cinema. But as you've probably realised, the good thing is that the thread of what you see here today in Everyman has come from somewhere very different than cinema. I hope I've added value to it the last 5 years, but certainly not destroyed the ethos of coming at cinema from a very hospitality-led background. So I want to flick through the presentation deck. I've got a little bit of background too, as well as where Everyman's come from. But crucially, we will be talking about the results, and Elizabeth will be joining me to go through some of the figures side of things. I'm tempted to say go gentle with her. She's been with us all of 10 days, but to be honest, she's done an extraordinary job in both pulling these numbers together for us at these interims and also rapidly comprehending the nuances of this business and how exciting it is. So I'll let her introduce herself properly a little later on. The highlights of the results that we've just brought to market are summarised pretty much by the word growth. I always apologise to existing investors for when I come and I say we're delivering in line with expectations, because I think it is the most dull way of saying we've delivered fabulous results again. We're obviously delighted that we continue, and it's been many, many times now that we've come to the market and said we've continued to deliver in line with expectations. And clearly in this market at the moment, with other things going on elsewhere, that is something to be proud of and be very excited about. Sub-bullets from that, we've got increased admissions and market share, a lot of that clearly being grown from new builds, and we opened 2 new sites in the first half of the year, and I'll talk more about the short and long-term growth plans for new venues. Crucially though, we're continuing to drive growth from the existing estate in exciting ways, whether that's in the F&B spend, which we'll talk more about, the use of technology, and also in the area of marketing and some exciting sponsorships they've had. I don't know if anyone has had a hot drink whilst you've been here, but if you've had, hopefully you got a free bar of Green and Black's chocolate with it, just to give a name check to one of our important partners. Finally though, and obviously extremely important talking to you here today, the opportunity for further growth is still immense, and I'll talk about that in some detail off the back of Elizabeth's financial slides. So just a little snapshot of the journey so far for Everyman. Back here in the early noughties, our chairman, Paul Wise, who was a local of the Everyman Hampstead, the original Everyman Hampstead, got involved with the business there and was effectively a classic disruptor in coming in as a regular cinema goer, but not really knowing the business of cinema. He was an ex-trader by background. Came in and asked some of those really obvious questions like, why couldn't cinemas have comfortable seats? Why couldn't they have nice wine? Why couldn't it be served in a nice glass? And why can't I take the glass through to the auditoria? And probably most crucially, why can't I be surrounded by a team of people looking after me who seem as excited as really they should be, given we work in such an exciting industry? Very disruptive, clearly. And he came in and made Hampstead the success that it was. It really was very special, and he brought some private investors together to allow him to buy the Screen Group in 2008, which was a collection of 7 venues, most of them again in North London, a Screen on the Green, Belsize Park, Baker Street, and also some out in the Shires in Winchester, Reigate and Hampstead, and Walton-On-Thames. Spent a few years getting the model right and rolling it out, especially into the North London sites. Then in 2012 and 2013, a couple of key things happened. First of all, they tried it out in the Surrey countryside in Walton-On-Thames, almost the countryside. It worked extraordinarily well, and that was the first foray really outside of North London, and was the start of a journey that then saw us start to have increasing confidence as the more we rolled it out to a more diverse array of both towns in terms of size and demographic, but also nationally across the country. And it just continued to work. Strangely, it wasn't just people in North London that liked the idea of a really comfortable, exciting, high hospitality evening out at the cinema. And that really was the start of the deluge. I came into the business at the end of 2014. The pipeline had already started to be formed. I wasn't solely responsible for this amazing growth, but did help, and subsequently, that is what we've been doing. We've been growing this business from a small brilliant idea into something that is being enjoyed by millions now across the country. And I really do mean that, having opened Glasgow and just signed Plymouth recently, we genuinely are a national business. 4 things really that we like to hone in on if you wanted to really talk about the key differentiators and what makes Everyman so special. We really do invest, and I hope you saw that today here at King's Cross, we really do invest in the venues themselves. We like to say that they should be really strong, credible venues that you would genuinely feel quite happy sitting down, having a gin and tonic or a beer or a coffee, regardless of the fact that we happen to be showing films next door as well. Hope you agree that we achieved that. And that confidence and investment in the specification is then paid back in full with the success of the individual venues. The bottom right-hand picture here is Crystal Palace, which is a venue that we opened a year ago. We bought this off, it was obviously originally, as you can see, it was a cinema. It spent many years initially as a bingo hall and then latter days as a church. And we went back in, bought it and changed it and transformed it into this amazing venue that it is today. And whether we go back into new buildings like here at King's Cross or into old traditional cinemas, we still think we bring something very special in terms of the environment. Food and drink is significantly important for us, but at the same time, we're very careful about what we do and what we don't try to be. We are not trying to be a three-course restaurant. We like to be next door to really high-quality restaurants. We like to be part of a collective evening out destination scene. We want to be in places where people will frequently come back to, sometimes maybe to come to the Everyman, sometimes to that nice restaurant next door. But if you are hungry, and if you do arrive 40 to 45 minutes before the show, which most of our customers do, we can certainly fill you up. Everything right through to burgers in most of our venues now. But the real key word here is quality. All of what we do is very simple. It's produced by our teams locally in venue. The guacamole is prepped every morning by our team. Our cookie dough is made fresh every morning by our team and then cooked. Everything is prepped in venue from the cocktails. But the menu is deliberately kept tight because we are still dealing with a few hundred people in quite a short period of time. And we don't want people poring over a 200 long wine list. So we have 5 quality reds, 5 quality whites, 2 quality rosés, and we keep it tight and we evolve it. We are still about showing film. And I think it's really important to know that I made the jest just now about we happen to show films next door. People are still coming to see the film. But what's really important about the film is that we don't want to be defined by the film that we show. We want to be defined by our audiences, and we will then show the films that our audiences want to see. And guess what? That varies from venue to venue. So in certain venues like North London and in Bristol, that breadth of content can go right through to the small independent niche films, and we can do very well. Those same films might not work in the likes of Birmingham or Leeds, and we might show far more of the mainstream films. Certain films like Avengers and Rocket Man are big, large films that will show everywhere and do very well. And then other films are more curated and picked. And that's really important. We show what our customers want to see. We're not in the business of education. We're not in the business of preaching. We're in the business of entertaining. We want people to come out 4, 5, 6 times a year and escape and have an incredible evening out. The live cinema, event cinema as it's called in the industry stream, is really important. Nationally now, across all cinemas in the UK, this now counts about 3.5–4% of box office. For us, it's about 7 or 8%. And the success in growing audiences and introducing this type of content to existing audiences has been phenomenal. Whether it is the Met Opera or the National Theatre, Roger Waters in concert next month, that's been a really important strand of development for us over the last 10 years. Finally, by no means least, our teams. Very easy to make a slide like this, very easy to sit up and say, yeah, our teams are really important. They are. They are the biggest differentiator, and they're also we believe, our strongest competitive strength in the market. We encourage young, dynamic staff to have fun at work and have a sense of empowerment and a sense of responsibility and pride in what they do. When I started working with Paul Wise 5 years ago, and we were talking at that time about taking 10 to 20 venues, our biggest concern was making sure that we still, at 20 venues, made each and every one feel like an important local community cinema that had a sense of ownership. If we'd failed that, I think we'd have both wanted to stop. As it happens, we've got to 28, and I believe, and I hope we believe, and we strive to believe that we've done that, and we will continue to do that right through 40, 50, 60, 70 venues to come. They're what it's about. So flipping back to the results and the highlights, We are now, believe it or not, the fourth largest cinema business in the UK by number of venues, with 28. 28 nationally, we talked about it, from Glasgow now down to Newcastle, Harrogate, Bristol, and Winchester, further south at the moment. The results will be talked through by Elizabeth shortly in more detail, but the real headlines are revenue up 16% to nearly £29 million now, which is extraordinary when I think back to those numbers just 5 years ago when I joined. EBITDA, reported EBITDA, is up 62% to 6.6 million. But I would caution you there and hope that you're all familiar enough with IFRS 16 to know that there's an awful lot of bizarre numbers in the stat accounts this year with that change of accounting principle. But most importantly, and again, Elizabeth has done this for you later, if you restate that on the old accounting principles, we saw a 20% growth in like-for-like EBITDA. So that, as you would hope, the profit is coming through at a greater rate than the revenue. Average ticket price remains a real strength in terms of KPI for us versus the industry average. But don't get carried away by that 85%. It doesn't mean that we're charging nearly twice on a Saturday night. We do charge small premium, but it's typically more a couple of pounds. But crucially, we don't discount anything like as much as the multiplex circuits do. We have less children coming through. We don't partake in 2-for-1 promotions. We're confident, and because we believe we're selling the Everyman experience rather than any given film, we have confidence in making sure that we do not devalue that with over-promotion. As I said, we opened 2 new sites in the period. We also signed contracts for 3 new further ones. And again, I will talk about that later. Crucially, on a like-for-like pre or post IFRS 16 basis, we are really well placed for significant earnings growth both this year and next. Operational highlights. What have we been doing? We've been building, as you would hope, and it's important to note that clearly the vast majority of the growth you'll see in our numbers at the moment is still being delivered and will continue to still be delivered from the opening of new venues. 2 new venues so far this year with 3 and 4 screens respectively in Horsham and Newcastle. And those 2 venues are really great examples for us of the contrasting types of opportunities that are out there for us now. Newcastle is an urban city centre location. Horsham is a small market town, medium-sized market town. And actually the success of both is what has really opened up the map for us in terms of the opportunities for further expansion. Again, more details to come. We also invested in a new venue at Gerrards Cross. This was an important site for us, one of the 4 that we acquired from the Odeon circuit 4 years ago. The Gerrards Cross site had 2 screens, was trading incredibly well against our original forecast before anyway, and had grown significantly over the last 4 years, and was effectively over-trading. So we've actually invested over £1 million in building a 3rd screen into the car park, and also reconfiguring the kitchen and bar to allow it to do the full expanded burger menus. That could well be the most impressive return on investment of £1 million we've ever spent. It's flying, and has overnight delivered the increase in admissions that we expected and hoped to see, and that's flowing through nicely. We've also refurbished our Walton-On-Thames venue. This is a programme that you'll see us doing more and more in the coming years. This was upgraded to the full Everyman offer in 2012, so 7 years old. We went in, we spent £250,000 on refreshing that, including recovering all the sofas, redecoration, and smartening it up. And that kind of £250,000 every 6-ish years for venues is the kind of maintenance programme that we'll be planning in going forward longer term. Mentioned already the F&B, unapologetically, the 13% growth in H1 F&B spend per head is something we are very proud of. It's been growing nicely over the years anyway, but this growth in the last 6 months has really been crystallised by a number of long-term things that we've been working on. 3 real pieces of this. It's not significantly driven by price, and I would absolutely flag that. Yes, we bring in inflationary increases, 1 or 2% a year, same with box office pricing, and I'll talk about that in a moment. But the vast majority of that 13% has been come from really good, innovative development that's allowed us to deliver more F&B of what our customers want every time they visit. That's been done through ongoing menu development. I believe some of you are busy sampling some of our antipasti small plates that we launched earlier this year. That's been a significant success, as has been the redevelopment of our beer range. That's kind of like evolution of the menu. We operate a very strict 1 in, 1 out with the menu. If we introduce something new, we get rid of something. We want to keep things tight and easy to read and order. We've also had a great success of rolling technology out appropriately across the business. We've always done bar sales. Our teams have always been asked to go out and about the bar and offer service even into the screens before the film starts. The technology we had before was not great. We've now rolled out iPhone technology with back-to-back PDQs, which now means that two important things. One, they work. Two, people aren't carrying 2 bits of kit around with them. And it's moved things from our teams actually dreading being the fatal words on their shift of, would you mind going out and walking the bar? And actually fearing that, to actually embracing that because the kit works and they actually like talking to our customers and interacting. That's had a big positive effect on spend per head. But we've also been learning an awful lot from the development of our new venues. Our new venues come in and trade a good couple of pounds higher on average spends than our older venues because we've been increasingly feeding in operational design improvements to those new venues. That's come down to the inclusion of dispense bars, for example, better proportioned kitchens, better prepped kitchens. And all those learnings, where possible, we've tried to roll back, although obviously with things that take physical space, that's not always possible. But those things, those continued learnings and rollbacks are all part of that journey on F&B. We're also seeing growth in ancillary revenue, some terrific growth in sponsorship and advertising at 31%, mainly driven by the sponsorship side of things, and having mentioned Green and Blacks already, a great partner for us, as are the likes of American Airlines and Wild Turkey. We want to partner clearly brands that make sense. They want to partner with us for the same reason, but we want to work with people who will deliver added value through to our customers as well. And that's how we activate those partnerships is very, very important. We have an increasingly growing members base, 20,000 paid members through our 3 schemes that we have available, but crucially also 260,000 subscribers to our newsletters who are also incentivized to log in when they purchase. So that actually means that we actually have active data on over half our admissions. So in any one day, or half the admissions that we see, we know who they are, and therefore we can track and monitor and appropriately target with the right kind of incentives or awareness of coming content. That leads nicely into the investment in marketing. We've created effectively a digital marketing team with a social media manager and a digital marketing manager joining in the last 6 months. And ongoing, we will continue to invest centrally as well as across the business, but clearly, as you would hope, and Elizabeth will illustrate later, at a lower rate. So we're still getting this great flow through from new revenue dropping straight down. And finally, I don't know if any of you were here at King's Cross in the summer. We did the outdoor cinema again with Argent, the developer here, very successfully, and also a pop-up in the Grove. These are primarily about keeping the Everyman brand front and foremost in people's heads, especially during the summer when some people get diverted by things like sunshine. But they also can make us some money as well. Key performance indicators, really quite simple. Admissions have been growing really nicely. The first half actually, like for like, was slightly down in the market. It was about 4 points down against a very, very tough comparable in 2018. But the second half of this year is looking much stronger than the same comparable in 2019. So we're all expecting the market to fully recover and possibly and some. But that 4% drop, obviously with the new venues that we have opened, we've actually delivered a 9% increase in admissions up to the 1.5 million mark, which is phenomenal. The average food and beverage spend up to £6.95 we talked about. And the only other 2 points to note here, one is that with the admission growth, we actually reached 3% market share for the first time. And obviously that's growing nicely. You can see that historically. It appears that the average box office spend per head has dropped back a penny. It has. But in reality, the rationale behind that is just reflective of our disproportionate growth outside of London. Most of our new venues the last few years have been outside of London, where the ticket price is lower. You'll be glad to know that rentals and associated costs are also lower, so they make very good investments still. But the blended average has dropped back a little bit. With the coming pipeline and a few sites coming back into London, we would hope to see that start to creep back up again. But in reality, we are delivering 2 to 2.5% inflationary increases every year by venue to keep them in line with inflation. Nothing more, nothing less, and that's flowing through. At this point, I'd like to hand over to Elizabeth, who can take you through some of the more financial aspects.
Hello, everyone. Before we move on to the numbers, just a little bit of background on me. As Crispin said, it's the end of my second week here at Everyman. My sort of background before that is I'm a chartered accountant. I've had a number of roles since qualifying a long time ago. Most recently, I was the CFO at Science in Sport, which is also listed on AIM. And then prior to that, I was the finance director at Hugo Boss for UK and Ireland. So in terms of managing sites and managing investment appraisal of sites, I've had a lot of experience of that previously with Hugo Boss. Let me start with taking you through the P&L. So what we've done here is we've obviously reported the statutory reporting of the P&L, which does include the adoption of IFRS 16. And then for comparison, so that we can understand what's going on sort of really in the business, we've got the pre-IFRS 16 numbers. Revenue at the top, that's the 29 million, just shy of 29 million, which is the 16% increase year on year, which we've gone through. So we've got the ancillary revenue that Crispin talked about, and then we've got our admissions and our food and beverage, and roughly admissions are 2/3 of that and food and beverage 1/3. Then coming down to gross profit, we've grown that year on year, obviously, with the revenue, and it's up slightly on percentage terms, and that is because the average spend per head on food and beverage has increased for the reasons that Crispin mentioned. Then we get to the overheads in the business, and you can see here what we're now reporting is overheads flat year on year, which clearly won't be the case in our business. But if we go to the box here, we've broken those out. So those numbers that we've reported split out into labour costs, which are up significantly, but they're up in line with the growth in our business and the growth in the number of sites we have. So that's what's driving that growth. And as you know, service is such an important part of what we offer to our customers. I'll come back to property. Admin costs, so back office costs, are up 8%. So the key point to note here is that we've grown the top line 16, but we're keeping our back office costs under control so we can leverage further growth from the costs we already have in the business. We have added a few extra roles in head office around marketing, digital marketing, and that will continue. There will be some extra resources we need to put in as the portfolio grows, but we're confident that we can keep the growth in overheads, sort of roughly under 10%, so that what we're growing on the top line, we get much more falling through to the bottom line. Then if we look at property, obviously with the addition of new leases, that looks a bit strange that our property costs have gone down. So if you go to the box at the bottom, you can see there the P&L charge for rent that we would have had historically would have been 1.7 million. So if we add that into the property charge, it's gone from 3 million to 3.5, which again just reflects the fact that we've got more venues in our estate. So that gets us to the reported EBITDA of 6.6, which is the 62% growth. But on a like-for-like accounting basis, we're at 4.9, which is 20% growth in EBITDA. And the next big sort of change on the P&L is the depreciation number. So with IFRS 16, we've now got a right of use asset on the balance sheet, which we have to depreciate over the lifetime of the lease. And so we've got 1.2 million of depreciation on those assets, which we've never had before. And then also we've got an increase just generally in depreciation because of the investment we've had in the new venue. So that's why there's been a material change in the depreciation charge. What else comes with IFRS 16 is this financial expense. So 1 million of that is the interest that we have to record on lease liabilities. Now, obviously, that's not a cash movement, but it has to appear in the P&L here. So that is inflated by this charge down here. So when we look at the bottom, we are reporting 560 for the period, which looks like we're down against last year. But actually the impact on the P&L from IFRS 16 has been this 473. So we're actually really pleased that for the first time we've got in the first half £1 million of profit. Unfortunately, we can't report that, but that is the underlying performance of the business. Just moving on to the EBITDA bridge, I think another important point to note as to why we are really pleased with the results for this half is we also had 27 weeks trading in the results for last year. So this year we've lost a week of that. We've only got 26 weeks trading in the period. So if we look at what the EBITDA contribution was of that, it was around about 0.3 million. So against that background, we had 4.1 million EBITDA last year. Then on the admissions point, we've lost a bit of EBITDA because of the week, but also, as Crispin said, the market was down slightly, but we expect that contribution from admissions to be positive in the second half as the film slate comes through. Against that, though, we've increased our margin from average ticket price and sales per head on the food and beverage, so that's negated what we've lost on the admissions side. That 0.3 there is the investment in back office to support the growth of the business. And then for the new venues, we've got a positive 0.9 million contribution to EBITDA. And then to get to the reported number of 6.6, we add back the rent. So that's the journey from last year to this year on EBITDA. Moving on to the balance sheet, where again you see huge differences because of the adoption of IFRS 16. As you would expect, we've continued to invest in new sites, so then the investment in assets has gone up, but we've also got the new right of use assets, which is based on the rent that we have to pay on all of our leases. So that's that increase there of 47 million. And then against that, we've got the lease liabilities, which we discount at our borrowing rate. So we've got 2 million in current and 59 in more than 1 year. So that does change the shape of the balance sheet a bit. But I think the important thing to note is that our net debt position is just over 9 million. We have a revolving credit facility for 30 million, which we took out at the beginning of the year. Previously it was 20. We've renewed it for the next 5 years. And we have used 11 million of that. We drew down another 4 million in this period. And then against that, we've got just under 2 million of cash on the balance sheet. So our net debt position is 9.1 million. So we've got 90 million we haven't drawn down on. And when we come through and talk about our investment plans and the properties that we're looking at for the next few years, the rollout of the 6 sites a year, we're fully funded to cover those with the existing facilities that we have. Got a detailed slide here. I won't go through all the details, but it just shows you the journey of how you get from one balance sheet to the final reported balance sheet. So if anyone really does want to go through all that and has any questions, then of course I'm more than happy to take them. But I think that's probably a bit too detailed for right at this point in time. Going back to what I was saying on the cash flow, we have got cash from operating activities in the period. We've generated just under 3 million. And that is going to grow because we've got maturing sites now. And as soon as a site is open, it becomes cash generative. The business, the sort of cash model is that we get the admissions in, we get the revenue in, but we don't pay for the film until quite a while afterwards. So the minute the site opens, it supports itself from a cash perspective. So we generated the 3 million. That 8.4 million is all our investment in our properties. And then we have spent some money on developing an app, which hopefully you'll all, if you haven't downloaded it already, you will. An upgrade went live yesterday. It's a really important way for us to communicate with customers and to build that sort of brand loyalty. And then there you can see that we've increased our facility by a net 4 million. So that's where that movement has come from. But as I said before, we are confident that with the cash generation that we're achieving and growing in operating activities, plus the credit facility we still have available, we are happy that we're covered for all the new sites, plus the refurbishments that we're starting to do, sort of 1, possibly 2 a year going forward. And then Crispin will go through where we're going to use that facility to grow the business even further.
Just the point on that. So as Elizabeth said, we're drawn down by 11 million on the current facility of 30. We have a covenant there's around 2.5 times. In reality, it's the board's desire to keep that leverage down below 2. So whilst we still have the 19 left to spend, apparently I'm not allowed to do it all this year. But as you'll know from the forecast EBITDA for this year, 12.1, that 9 will be comfortably below 1 times. So yes, getting on to how I would like to spend it all. We talked about the expansion massively, and the map there is particularly gratifying. So 5 years ago, when I started working with the current chairman and board, all of the 10 sites, 9 were literally in that southeast cluster, and we had Leeds in the north. So to see that map now and to have become a true national brand is extraordinarily gratifying. So we have 28 venues open, 92 screens. So in the space of the next 4 weeks, we're due to open another 3 venues and another 9 screens. So in Manchester at the end of October, we will open our 100th screen, which is an incredible milestone for us. We also have an additional 15 venues listed here that have been signed and agreement for leases. We only talk about specific venues when they have got to signed and executed agreement for lease. And clearly there's an extraordinarily high chance of these all coming through now. We also have at the moment, at this point in time, we have another 8 venues that are in the hands of solicitors, if you like, that should also come through. The key thing here, though, also is at the moment you'll see here we're only looking at 4 venues opening next year. In reality, of those 8 venues that are in legals, there's a high chance that 1 or 2 of those will come into next year. Increasingly, the types of venues that we sign, in fact, 5 of those 8 are going into existing spaces that have already been built. Now, whether that's old distressed retail space, or in the case of Newcastle earlier this year, an old nightclub, they're the types of locations that once the agreement is signed, we can get in and get open very quickly. So it's no coincidence that the later sites, the 21, 22, are all the new builds. They're the ones that we can sign. We often get very good incentivization to go into new builds. The downside is that it can take some 3 to 5 years. We signed the Durham location 3 years ago. It's still 2 years away from opening. So that's the downside of the new builds. But the capital contribution on some of these schemes can be that much more attractive than if you're going to an existing distressed retail space. Clearly, there's been good movement on rent the last few years, and we've been able to, in return for those extended 25-year leases, actually get some very good contributions and, crucially, some protected rental values in those leases. It is very exciting, the geographic spread and the scale, different sizes. We've got 3 coming back into London in the next 18 months. We've got Broadgate opening in just over a week's time. Check your dates if you're watching this recorded. We also then have Clitheroe in Manchester this month. But in London, we also have Kings Road, Chelsea opening in summer next year, and Borough Market opening early in 2021. We also, in that same period in Q1, we are opening our largest recent site in Edinburgh, which is 5 screens, 16,000 square foot, which is part of the phenomenal new St James's development opening at the east end of Princess Street. So that's very exciting and gives you a good breadth. So we can go from a big development like that in an amazing cultural city like Edinburgh through to small 3-screeners in small market towns in rural countryside. I think crucially, the real key message here is, even though it sounds ridiculous now, I'm talking about the fact that effectively we've committed to 51 sites, or will have done if those 8 come through legals, is we believe there's scores and scores and scores more dots on the maps now. Now that we're finding actually deals to be done that are in these smaller market towns that make an incredible amount of sense. And the real crucial thing to remember here is our threshold of 20% IRR. That is absolutely sacrosanct. Has been from the start, and we continue to do it, and we've had an immense success with the portfolio delivering against that. And just because we're going to small market towns, that actually, yes, the net bill cost is lower, the rents are lower, and the admissions can be lower and still deliver that level of rental. That's why we sit here and we talk about, quite realistically, this business can get to 70, 80, 90, maybe even 100 venues across the UK. And anyone looking doubtful at that would just say, if someone had told me we'd get to 51 in 4 years ago, I'd have been, that story has written itself, really. So that's the exciting part on the UK. You will, however, have noticed that there is a little red dot popping over the Irish Sea, and this is our Dublin site that we have just signed. We are going international. We've often talked a lot about how effective the Everyman model could be internationally, and the opportunity came up to go in Ireland. I have experience of Ireland myself from my Cineworld days, and there are some really, really attractive aspects of the Irish cinema going. First of all, their frequency is nearly 20% higher than in the UK, 3.5 times to the 2.7 times per head in the UK. Crucially, obviously, it's geographically close and there isn't the language barrier. It is still international, as you all know very well. We have geared up for that. There are still the challenges of going international, and we're aware of this step, which is why we've gone for a nice small 2-screen cinema in the centre of Dublin. It's lower risk, there is still risk, but we're very confident that this is going to be embraced by the Irish, as have many other different formats of cinema over the years. It's also important to note that we're not intended to go into Ireland with just one venue. Yes, we are going to get it open and check that we're not that it's delivering to our expectations. But we believe that the Irish market could easily take 6 to 10 venues across the country, probably another 3 or 4 in Dublin, and spreading out more across the country. We would want to accelerate that off the back of the one opening, and therefore make the central investment in going international make sense. Just a quick step back and looking at the UK cinema market. We have succeeded at Everyman in flipping the equation on purchasing cinema. Most people in the UK buy cinema with the simple equation of the Joker is out next week, where is it showing, at what time is it showing, and is there free car parking? And that has been the traditional purchase model for cinema for decades in the UK. What we've had great success in achieving in Everyman is flipping that around, people saying, I want to go out next week, I love the Everyman, what's showing? And the moment we do that, we've flipped around to things we've created and gotten that success of a venue as a destination through. But crucially also, it means that people are a little bit more inclined to take a risk on the film they see. It doesn't become totally dependent on the confidence in the film. So whilst the tentpoles and the strength of the underlying market is of course important for us, we're slightly de-risked against the big blockbusters through a year. And we tend to find that our share of the market over-indexes when those tentpoles dissipate. And we continue to get people coming into the venues to see the smaller films that are often actually, just as enjoyable, if not more so. Interestingly, we've also this is a lineup of films, and we talk about the strength of films through to the end of this year. It's extraordinary year on year, and you couldn't fit them all on here. It's The Joker, through to things like over the half-term holiday, Maleficent, Shaun the Sheep, Last Christmas, Frozen 2, Jumanji 2, Cats, Star Wars. The roll through to the end of this year is quite exceptional, and hence our confidence in the phasing of the year just coming back through in the second half. A slide here. If I'd had £1 for every time that I was told that Netflix or Amazon was going to kill cinema, I'd be a wealthy man. I'd be even more wealthy if I'd had £1 every time someone said to me over the 3 decades I've been in that the VHS was going to kill cinema, or Sky Movies was going to kill cinema, or Blu-ray or DVD was going to kill cinema. And you can see from the growth in UK admissions from 54 million in 1984, interestingly, free TV channels VHS launched, and VHS was going to be the death of cinema. It wasn't. It was part of the resurgence because the downstream opportunity for film producers to make money meant that more films were put into production. And that increase of 200 films being released theatrically 30 years ago through to 900 last year is as a direct result of this opportunity that's open to them all. So we have this huge breadth of content, and it's always been my belief personally that the more people watch film in any format, whether on the tube, at home or in a cinema, the more addicted they get to film in a really nice way, and the more they want to watch film, and ultimately the more they'll go to the cinema. This research from Ernst & Young was produced 8 months, which completely validated that argument. It actually shows that there's an extremely positive correlation between the amount of times people go to the cinema and the amount of streaming they do on a weekly basis. Most crucially was the observation that of all the people in the research that had not been to the cinema in the previous 12 months, 50% of them had never streamed. So they weren't not going to the cinema because they were streaming. They probably just aren't interested in film. Can't imagine who they are, but they are out there. The key thing is, if you're a film junkie, then you will stream and you will go to the cinema, and the one will drive the other. So we're very confident and excited about the future of the UK landscape. In conclusion, we have continued to consistently deliver the pipeline of new sites that have come through. More crucially, we've continued to deliver growth in the existing venues. The ambitious rollout plan and the development of the pipeline is as exciting as ever, with 15 now in that committed pipeline. And crucially, again, as Elizabeth said, the drop-down flow-through of those new revenues now is getting more and more efficient straight down through. All of the pipeline is fully funded by our current facility. We continue to ensure we do that. That is in place. So in reality, those next 15 new sites and the 8 beyond it over the next 4 or 5 years are just going to come into an existing business that's growing cautiously and sensibly and drop down and deliver those increasing profits. Thank you.
Thanks for an excellent presentation. Can you talk a little bit about the food and beverage? Give us a little bit more colour on that. Is this a one-off 13% increase because of the increase of technology, or do you see this just carrying on like a ski slope and doing very well? And when do you think it might start to plateau? Because it seems, and also can you comment on the margins of it as well? Because it seems that could be a really big driver going forward.
Oh, so many questions.
Sorry.
First of all, I'd say that, yes, I'm absolutely not going to sit here and say I'm expecting 13% growth year on year. But what I would say is the last 4 years, since I've been in the business and actually since we brought more and more experience into the business, we have been delighted at the rate of growth. And we've seen 6, 7, 8% growth as well as 13. I think inevitably in terms of percentage growth, it will slow. But I would really genuinely hope that we will continue to trade well above the pricing that we put in for a number of years yet as we permeate out across the entire estate, all the learnings and then the continued operations, the continued opportunities. So I think, you know, we can't get into forecasting. You wouldn't expect me to stand here and forecast, but I'm still confident that there's more growth to come in that area. In fact, usually the thing that most people pick up on is £6.95. I know that's net. Okay, let's make that £8 gross. I always spend a lot more than £8 every time I come to an Everyman. In reality, of course, that's a blended average across quiet Tuesday afternoons when Downton Abbey might be showing versus a Friday night when Joker, and you get very different spend profiles. But we certainly believe there's growth there.
As the product sort of is becoming more known sort of nationally, and then you have a national expansion plan, and now so talking about the international expansion, will you consider the franchise model as a means of really grabbing significant market share?
I think we've always been very reluctant to consider that. The real differential, the real competitive edge that we have is in the service we offer. And I think we would always want to make sure that we have absolute control over that. You know, we have some cinemas that we took a long time to get fully up to scratch in terms of the sofas or the decor, etc. But from day one, we've had brilliant teams in those venues, and that's always fostered great customer loyalty. It is the number one differentiating factor for us. And I think that's the piece that would always make us cautious about going that route.
At what stage do you decide that a film will not perform financially for you?
That day after it's been released.
It's just that in my experience, you know, they say that, you know, as soon as a film is released, within the first weekend of showing, one knows whether it's going to perform, and there is a very predictable financial performance associated with that one weekend, the first weekend of showing.
There's absolutely no denying that the first weekend of any film is crucial. What I would say is that there are films that require longer term word of mouth to fully find their audience. And indeed, even more commercial films that are brought with a big above the line spend, if they appeal to an older audience, often take longer to realise that revenue. So something like Downton Abbey, it was a great success. It delivered to expectations for the studio in weekend 1, but it will probably still be playing in venues in weeks 4, 5 and 6 because the older audience tend to take a bit longer to realise that it's actually out, or you've got busy schedules. So it takes longer to plan that journey in. Whereas a film that is a big event film targeted at 12 to 20-year-olds. It's like a Nike trainer. People want them that first weekend. And that first weekend can be as high as 40% of its total box office take. So without going back to my flippant comment, I mean, yes, by Sunday, after a Friday release, you have a fairly good idea of how the film's going to play out, albeit maybe on a slightly different tail profile.
And if it doesn't perform, you just ditch it?
If it doesn't perform and we don't think that there's any confidence that we can find that tail, then yes. I mean, we program every Monday for a Friday release, so it's a very fluid and flexible programming.
Just on the topic of potential just short-term bumps in the road, to what extent are you now becoming more exposed to the film slate and the popularity of potential movies? I know what you were saying about, look, when we're in North London, people come to Everyman, then they pick the film, but maybe more when you're going to Newcastle and places like that, and as you're expanding geographically and moving away from North London into these sort of major towns and cities, are you becoming more exposed to whether or not the James Bond film hits and to the slate of films going forward?
No. No, I think if I could pick you up on two things there, I think the type of film that our North London customers might like is different to those in Leeds, but I think the way in which they're using Everyman is exactly the same. They are still, we've still succeeded in flipping the equation, and there are 900 films released every year now. So every week there are 15 for us to choose from. In reality, there's 5 or 6 that actually might make sense. It's very easy for us, A, to pick films, and for B, for them to be films that customers will come see. I mean, that said, the breadth and of film and film loving is extraordinary. You know, so you go back 3 weeks ago, you know, the big film was It Too, and our cinemas were full of predominantly young professionals coming out on the Friday and Saturday night. 1 week later, we had Downton Abbey, and the average age had shifted up some 2 decades, and suddenly we were having full cinemas on Tuesday afternoons as well. And that's what's amazing about the cinema business. And there are films dotted around all over that will play to all those different customers and what they like. And I think we just keep focused on the things we do control, which are standards, hospitality, the F&B, and then keep making people want to come back, and they'll find something. So I think the tent poles, as I said earlier, they do give you a confidence in the medium-term future, but there's always gems hidden away that will break out if they're given half a chance.
Hi. Initially, you said you wanted to show films that people wanted to see, but how can you be sure that people want to see the films that you're showing? I mean, what is a hit for one film might not be the same for a similar film that's shown later? Or is it just the fact that people will come to your cinema and then pick the one film that they like out of the choice available?
I think, you know, we have a film team centrally who get to see all these films in advance. They're quite clever at getting and understanding and knowing whether a couple of things. First of all, the film themselves, whether they like it or whether they feel that its target market will find it good, whether it's a quality film. They also know, obviously, how much a film distributor is going to put behind it in terms of advertising spend and the like. And they'll also know whether it's the type of thing that we can work in our own marketing teams with getting awareness out. And I think you bundle those all together and you get a fairly good confidence as to how a film's going to open, and crucially also how we're going to perform with it. And, you know, jokingly we call it inside the industry the black art, and there is a little bit about it, you know, kind of like just that insight knowledge. You know, I think there are cinema chains out there that have invested a huge amount in computer programs and algorithms that they claim are very successful, and they may be, but we don't have those. We've got a film team that's just got that experience and knowledge from many decades of just gauging films. But you can never be absolutely certain, but it's very, very rare that a film opens and does more than 10% either side of what we're expecting.
And one quick question about the company. What sort of percentage of the shares are held by the management team?
Well, we like to offer, we like to have our management team optioned up. In fact, we just we issued some new options today, but it's not just to the senior team, it's right out to the broader team. So we try to every year give even our venue managers and the teams in head office share-based incentives to deliver, but over the long term, 3 years. I think the options in issue at the moment just ticked up to about 8%.
I think you'd mentioned, Crispin, that your target IRR for a new opening is at least 20%.
Yeah.
But you're not really in a position to undo a lease which has been signed. So have there been instances when you've signed a lease and you haven't hit that target?
We have 2 at the moment that are delivering in the high teens. So we haven't had every single one of the venues we've opened going back to 2012 have contributed from day one and are delivering a good return on investment. Yes, there's 2 that haven't quite hit the 20% hurdle rate, but they're still at high teens at levels that many other businesses would be happy with. You are right that it's a 25-year lease. It's a long-term commitment. That's why we're very, very cautious. So whilst 20% is the investment hurdle, if we're going into what we think is a riskier territory, we won't do it unless we actually think the confidence is higher than that level. And indeed, in those sort of riskier territories, that's where we can actually get more clout on the capital contribution and the rent and the rental protection to increase that gap really between what we think we'll get and the 20%.
And typically, how long does it take for a new store, a new screen opening to reach a maturity, like a steady state?
Typically about 3 or 4 years, but we're actually learning that because obviously we've opened 18 now in just 4 years, and we've been surprised by how many of those early ones are still growing by 3, 4, 5% per annum. And I think it kind of makes sense because we're kind of like a big hidden secret. when you think the average frequency of our age group, 25 plus, of cinema going is around 1.5 times. People sometimes, there are people that say the last time they went to cinema was the last Bond, and they're probably looking forward to next April for the next Bond. Well, if an Everyman hasn't opened in their cinema, in their venue, or if the Everyman's only just opened, they'll probably just wait until the next Bond to come and visit. Then they'll come and visit, and then they'll realise, actually, this is really nice. I didn't realise cinema had got like this. And then maybe they'll come and see something else, maybe later next year. So it's quite a, as I said, it's very discretionary and it's very low level utilisation. You're trying to buck trends.
Last quick one from me. Do you disclose what your organic like-for-like growth is?
We don't. Apart from, the main reason that is with the 28 sites we've got and the continued growth we're still seeing, when you cut it right back to, taking away all the extra investments we've done over the years, you get to a cluster of about 6 sites. And genuinely, you get to, because internally I do look at those. But then, 4 of them are in North London that has a very different volatility and film programming to the rest of the country. It actually becomes a bit meaningless. And I think it would send a few hairs running one way or the other unnecessarily.
Could you not do something like, say, you'll only compare like for like for a portfolio of screens which has been open for at least 5 years, let's say? And
we could, but 5 years, you're literally talking about 19 screens we had 5 years ago. That's the challenge. So I think, going forward, we may need to look at that. I mean, and we do show year on year you saw on the EBITDA bridge, the non-new contributing profit. But it's a little bit of a challenge. We may rethink it in the coming years.
There's growing fear of global economic slowdown. Being in the consumer discretionary sector, how do you think you are geared to cope up with that?
Confident, but never complacent. I showed you the admissions growth slide earlier. And on another slide that I use internally, I've actually circled the last 2 big recessions in the UK, which I think, but you guys might know better, were around here and around here. 91, does that sound about right? What I do know is when you look at them, in both of those years, UK cinema admissions went up. And there's something about the resilience of cinema at times when times get tough that sees it come through. Cinema generally, and I genuinely believe Everyman within this, remains an incredibly attractive, good value night out. And it's also a complete and utter escape. And I think in times of hardship, people still do have money. They're just a lot more careful about how they spend it. And it's a great return on that investment, if you like. And also, you turn off from your fears, your troubles for 2.5 hours. So I'd never be complacent about it, but I'd be confident that we'd weather our times. I mean, I know it wasn't recession, but let's face it, the last 12, 18 months have been something weird going on out there. And we set a new modern record in UK cinema admissions.
Crispin, Elizabeth, thank you very much indeed.
Thank you all. Belsize. Thanks.